Hi, in this video we're going to take a look at running and scanning pairs under a fixed regime as compared to using a time adaptive or time varying beta. And the pair we're going to use for this job is JOSB and FINL. Now JOSB and FINL are both in the apparel sector in the US. They're both market capped at over $1 billion, something like 1.2, 1.3. They have slightly different sectors. This is JOSB. They're what I'd call, I guess, smart casual with suits, sports jackets, polo shirts and ties and so on. FINL, or Finish Line, they're more into athletic apparel and shoes. Now to go back to the main chart, the plot you can see on the right is the spread of the two symbols plotted since January 2009. Now, it's not a chart that oscillates beautifully around zero, but it is profitable. If we run a back test on it, there are a couple of things I draw to your attention. First of all, this is a fixed beta regime, so it means that one half is generally not going to be the same in money terms as the other half of your pair. In this case, because the beta is 0.69, you've got the X side effectively 30%, a bit more than 30%. Larger than the Y side. Now this is a very simple strategy we're going to run. I'm going to hit the test button, and you'll see, although the chart doesn't look that promising, there are in fact 1, 2, 3 profitable trades on it. What's noticeable here is that the total profit per trade is in the 370s. Total net profit is around $1,100, which is not bad at all. If you look at the Z training chart, which shows you in time where these trades have fallen, how long they lasted, what really jumps out at you is that third trade. You'd have had to hold that trade nearly 2 years if you'd stuck by the signals generated by the system before banking your profit. Now 2 years is a long time. That's a lot of time risk. Let's say we're going to run this now under a different beta regime, and there's a quick way to do this in ArbMaker, is to use the details tab. As you just saw, I clicked there. Here you can change some of the underlying parameters of the pairs in your watch list. So for example, we're going to go from a fixed beta method to the Kalman. For the Kalman, I'll use 0.025 as the gain value. Gain makes the spread and the beta test more or less sensitive to changes in the daily beta of a given pair. I'll close this and I'll hit refresh. It'll reprocess the data using the Kalman, the modified Kalman. And when we re-highlight the pair here, please pay attention because the spread Z chart is going to change dramatically. Here we go. Now it's replotting. There you are. Now you have a chart that oscillates very nicely around zero. It doesn't necessarily mean we've made it better, and I'll show that by running the back test. Compared to the first back test where we had uneven money amounts on both sides, here we've got 1500 and 1500 just as our standard amounts we're running on this back test. The way we've made this money neutral is by taking the daily beta and applying it to the X symbol price. In this case that's FINL, and replotting it. This doesn't mean that you're trading on an adjusted value when the time comes to issuing signals and taking positions. You're trading on the real underlying prices. This is simply a statistical method, a robust method of implementing the change in daily beta on the spread. We could have taken it in the money amounts, but it's more elegant to take it this way. Now if we run the test, there are a few things that'll be noticeable when it comes back out. First of all, we've got more trades that have been implemented. Generally, these are all at a lower profit per trade, although the total amount of money made in this case is actually slightly higher than under the fixed regime. That's not always the case. It just depends on how well you optimize the gain value. If we look at the Z training chart compared to the previous chart with the fixed beta, what's going to be very striking is the duration of the trades. So here we've got about 6 or 7 trades, and when this chart comes through, there you are, you're going to see these trades are spread more evenly through time they're also of shorter duration, so you've reduced the time risk associated with holding a position a very long time. This is not to say that a time varying beta is always superior to a fixed beta. It's not. It's just a matter of horses for courses. Another noticeable feature of the time varying versus the fixed is right now we're on a time varying. If I show you the beta, you may recall earlier I mentioned that the gain, in this case we're looking at the Kalman, the gain makes the beta we use more or less sensitive to the underlying changes in the pair. That is to say, the price relationship between symbol X and symbol Y. That's represented by the red line. The Kalman beta is plotted with the black line. Here, you may remember we used a gain value that was 0.025. If I reduce this, that's going to reduce the sensitivity of the beta that's used in the rest of the algorithms. And I'll show you by refreshing. And again, you'll see two changes. This spread chart itself will change shape, but this black line will become flatter. Observe. There you are. Now it depends what a user wants to achieve as to what choice he makes on the gain value. We're going to have optimization of these parameters coming in hopefully the next quarter. Again, it's not necessarily the case that more sensitive gain is better than less sensitive gain. It really does depend on the pair and what a user is trying to achieve. And that's all for now. Bye bye and good trading.